Wonderful. Welcome everyone to our first financial literacy session hosted by the Centennial College Alumni Association. My name is Justin Lim and I'm the current president, and it is my privilege to welcome all of you here today. Before we start that, I just want to acknowledge the land that we are in, that we do stand on the land. We are standing today on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and Wedwat people, and is now home to many diverse First Nations, Inuit, and Métis people. I also acknowledge that where we are, Scarborough, Toronto, where our office is based, is covered by the Treaty 13 signed by the Mississaugas of the Credit and the William Treaties signed by the multiple Mississaugas and Chippewa brands. Awesome. And today, I also just want to share that some of our promotion and some part of the our partner here today is Johnson's Insurance. So I just want to acknowledge that as well. And today we do have two speakers. One is Alex. Alex is a member of the Alumni Association as well. And he is currently our treasurer. And we also have here Magleta, who has tons of experience when it comes to taxing and accounting. So I would let Margleta start our session for today. Just give me a brief moment here. Just share that for you.
Okay. Hello, so my name is Magleta Hodo and I'm working as senior accountant for PKF Antares Professional Corporation. We have like 3 different branches in the Canada. So the first one is the Toronto, we have the Calgary, and there is another one in the Red Deer. And we have another one, the 4th one that is coming up in the Montreal. Today I will have like a short presentation regarding the tax return in Canada. We know that the March is approaching and we have to prepare like the tax return. Let me share the presentation and we will go through on it. Just one second. Okay, so we can. Okay, so I'll have it like this. So we know that as the March is coming, so you have to prepare like the tax return and you have to collect, first of all the expenses that you have and also the T4 slips or the T5 slips, the one that you have to claim on the tax return. So there is a checklist of some tax issues that you have to focus and prepare the documents before the March. So I'll go one by one through all this list. So you have like, if you have any question during my presentation, feel free to interrupt me and we can discuss about it. Let's go the first one. One of the tax issues, which is an important one, is the rental income. So you have to ask yourself, did you rent any properties during the year to earn the rental income? If yes, you have to collect the total income that you earned during 2022. In the same time, you have to prepare the list of expenses that you have for this rental income. So the rental income can include like the renting a house, renting an apartment, room, space in the office building, or other real or movable property. So on the expenses that are related to the rental property can be advertising, can be the insurance that you are paying for that property, can be the interest that you are paying for the mortgage, because, okay, if you are paying mortgage for the house that you rent or any office, you have to claim this interest that you are paying. Repairs, maintenance that you are doing for the property, professional fees, because we know that you are paying like the property or the tax fees that you are paying for yearly, management and administration fee. There is the vehicle expenses because you have to go back and forth and check this house or this apartment. So you can claim these vehicle expenses that you have used only for the work that you have done for your rental property. Also, there is office expenses, property tax, travel costs that you can include, because sometimes your property will be on Quebec and you are living in Ontario, so you have to go back and forth, and of course that you are spending some of you have some expenses on it. Also, there is the utilities. Sometimes when you are giving like the property, then you are getting the income from that. Some of the utilities, like the owner is paying by itself, let's say the water and the electricity. So you can claim some of them there. Also, there is the landscaping cost, condominium fees, and the capital cost allowance. So what is the capital cost allowance? It's the amount of amortization expense that the government will allow a company to deduct from its income for tax reporting purposes. So some of the, let's say, items that you can be in the capital cost allowance can be like the furniture, the printers, computers, telephones, and more. So you can do the calculation in order to claim this capital cost allowance. Okay, so we can go to the second one, the tax issue, which can be the business income. We know that there are three forms of the type. There are three types of business. The first one is the sole proprietorship. The second one is the partnership, and the third one is the corporation. So we know that the sole proprietorship and partnership, you can claim this one on your own tax return. But for the corporation, we are filing like the tax return for the corporation, which is totally different. But the income, let's say we're gonna do like the Uber driver. This one you have to include on your personal tax return, will be the business income, and you can claim it there. Let's say you are using the e-commerce, is another topic, and again you can add all this income on your tax return because you are working as sole proprietorship. But also you have to remember that when you have like you'll do the calculation, and if the total income that you are earning from this business so is exceeding the 30,000%, you have to get the GST and HST from the CRA. Otherwise, the system is not allowing you to file the taxes for that one. Okay, you have the business on the business income. You have to claim like there is some expenses that you'll add like the total income on it. Also, you have to add your expenses. The first expense is the cost of goods sold. So what is the cost of goods sold? Do you know? So it's the main expense that you have for your, like for the business, for the work that you are doing. But this one can be only 30% of the total income that you have. And then we have the operation expenses, which can be the property insurance, can be the personal expenses, can be meal entertainment, in which you can claim only 50%. So let's say if you paid like 1,000 for meal and entertainment, but the system will take only 50%, which is 500. You have the home workspace expenses, because sometimes, okay, I'm doing the e-commerce, let's say, but I don't have any office. I'm using my home. So you can claim this home workspace expenses in your tax return. There is the vehicle expenses. You are doing the Uber driver, let's say, and you have some vehicle expenses on it, but you have to claim how much you are, let's say you are using your car. You have one car and you are using it for the Uber, but you have to claim if you are using like this car only for the business, or you are using for the personal use too. So let's say I'm using that one for 70% for the business and 30% I'm used for my personal work. So this one you have to claim on your tax return. There is again the capital cost allowance for the products that you have, and also for the vehicle. There is a travel cost that you can include, utilities. There is the office supplies, rental expenses, and overhead expenses that you can add. So which can be even the management fees, because for e-commerce like Amazon, you'll get like the report with total income, and also you have like the Amazon fees that you can add in your tax return in order to deduct some of the amounts. Okay, do you have any question until now? Okay, let's move to another one. I know that taxation is a little bit hard and boring topic, but I'll try to explain it with easy words. The other one is the investment income. So what is the investment income? What can be like the investment income? Interest, foreign interest, dividend income, foreign income that you have can include it in the investment income, foreign non-business income, because okay, we are living in Canada, but maybe we have a business outside of Canada. Maybe you like to use like the stock exchange. You want to invest on that. So all those interests that you are getting as income, you have to claim those on the tax return. Sometimes you can think that, okay, I don't want to add them, so because I don't like the CRA to see that I'm investing and I'm earning interest. But you have to know that all the investment that you are doing inside the Canada, there are the T5 slips that is going directly to the CRA. And when you are filing the taxes and you are doing like the out of field return from the CRA, the CRA is sending like you are getting directly the slips from the CRA. So there is no option to hide them. So you have to claim them. Investment income. Also in Canada, only 50% of the total capital gains is taxable. So, okay, you are, let's say, you earned 50,000 interest from the investment that you have done, but only 25%. 25 will be taxable, not all the amount that you are earning. And for this one, in order to claim the investment income, you have like the T5 slips in which you can get all the total amount in order to add in your tax return. Let's say if you sold or transfer capital property, 50% of the gain will be taxable and 50% of the loss will be allowed against taxable capital gain to reduce the taxable income that you have. You have a question? Can you, yeah.
So I just have a question in regards to the taxable investment. Is that something, because you said, is that something CRA would send us, or is that something that we do have to ask like the brokerage?
So you are getting like the T5 slips from the broker. So when you are getting it like the T4, you are working, let's say now for the college, and they are preparing the T4. When they are preparing the T4, they have to give the notification to the CRA at the same time. So these slips, one copy is going to your house and the other one is going to the CRA directly. The same thing is even for the T4 slips. T5 slips or T3, depends.
All right, thank you.
No problem.
Oh, sorry, and this is also, they're all in the same range as because some of them might be students here, so we do have T2 as well, right?
Yes, even that one is going to the CRA. If you are preparing them before February, they can find the T2202 is that one, they can find it in the CRA. So when the accountant will do the out of field return, they can get the form from the CRA accounts. But sometimes, yeah, I know that even the CRA cannot find it, or there is a problem with the college, with the accounts when they are doing like the declaration. So they can get from the school or from the, I think you have the school account and they can get from there. Okay. And then we have, let's move to the RSP account. So we know that this one is like famous in Canada. And with an RSP account, your contribution, you know, that are tax deductible, meaning that you can deduct the amount you contribute from the taxable income when you are filing like the taxes. Like you're gonna pay the less taxes and saving more money. Let's say you have to check like the account. I'll advise you, let's say, to complete like to do like the tax return currently, just not the formal one, not the official one, just to double check how much you have to pay the CRA if you have to pay back the taxes. So if you, let's say, you have to return back 1,000. Why you have to return that to the CRA when you can contribute that one to your RSP account? So you are saving money, and also you are not going to pay these taxes you're going to pay less taxes to the CRA. So you can check the RSP account room, and if you have still room on it, you have the time, there is a deadline until March 1st, 2023, that you can contribute for the RSP account for 2022 taxation year. And then, but let's say you don't have a room anymore. You can check first the notice of assessment for 2021, how much room you have. You can check the slips, how much you already paid for 2022. And if you don't have room on that, yes, you can go and save the money to contribute to the tax-free saving account, which is another account that you can use. But for the tax-free saving account, there is a problem that you cannot report this one on your tax return. So for the RSP, yes, will help you to reduce the amount that you have to pay to the CRA, to the government, but for tax-free saving accounts is not helping you. Just by contributing to the tax-free saving account, any income earned in the account is tax-free, even when you are withdrawing this amount from your account. There is another new account that's the government, like in 2022, they introduced it like the new account for the first home saving account, and is set to be available to the Canadians in 2023. It is basically provides like the first-time home buyers with a saving account that combines the tax benefit of the tax-free saving account and the RSP. So you have like the opportunity to save like 40,000 tax-free amount and buy your first home in Canada. But even the amount that you are contributing to the first home saving account, until now you cannot claim in the tax return, but will help you to contribute and save some taxes. So to open like this first home saving account, you must be an individual resident of Canada, be at least 18 years of age, and be first-time home buyer, meaning that your spouse, your common law partner, you have lived during at least you own any house for the last 4 years in Canada. Otherwise, you are not eligible to open this account. Another tax issues that you can use for the tax return can be the principal residence exception. Let's say if you sold your home or your you consider to have sold your property in the end of 2022, and it was your principal residence, you have to report the sale of the property on the Schedule 3 for the tax return for the capital gains and the losses. But there is a question: how to avoid the capital gain taxes on the home sales? What do you think? So you have the principal residence exemption, but you can avoid this capital gains tax on home sales. There are 3 options that you can do. The first, live in the house for at least 2 years, because in Canada we know that they are buying the house and they are selling and during the year, so it's a good business. But when there is not, they cannot claim it as the principal resident exception. But when you are living in that house, then you can claim it. You have to double check whether you qualify for this exception. And the last one, you have to keep the receipt for the home improvement that you are doing in your home in order to claim it in the tax return. Okay, let's move to another one, which is the moving expenses. Moving expenses can be claimed in general for your eligible relocations. Okay, let's say I was living in Ottawa and I moved in Toronto for my work. So I can claim those expenses on my tax return. So eligible relocation includes you moved at least 40 kilometers closer to your new job to carry on the business, or let's say to start a school for the full-time only, not the part-time. with the those deductible expenses claimed, you should maintain related receipts, bills, proof of payments that you can use for the moving expenses. Also, when you are claiming those in the tax return, you have to claim even the kilometers that you are doing, like is like 40, is 20 kilometers from your work environment and everything. So there are the following eligible expenses that you can claim in the tax return. There is the transportation, the storage cost, can be the travel expenses that you can use when you are moving from one city to another one, can be accommodation and temporary living expenses for maximum 15 days until you find like the new place. Cost of canceling the lease for your old home. If you have to move like right away, you have to pay this cost. Incidental costs related to your move that will happen. Cost to maintain your old home when vacant, which can be up to maximum 5,000. But for all of this, you have to provide those bills, because one day the CRA will come and knock your door, and the HSTA, like the examination will come, will ask for those documents. So you have to provide them. Otherwise, they will reassess your notice of assessment and you have to pay back for the amount that you claimed. The other one is the donation. Donation is defined as a gift for which no consideration is given as return. Because sometimes, okay, let's say if you are receiving an exchange, okay, I give $100 or $1,000, but I'll take a ticket to go, let's say, for a show. So for this one, you have to reduce the value of this ticket from the total amount that you gave. Let's say it was $1,000, the ticket was $500. So you have to claim for donation only $500, not $1,000 that you gave in the beginning. Okay? Did you get? Okay. So let's say I'll donate for the college $1,000. But the college will give me as exchange for this donation, will give me like a ticket to go in Cuba, which the total amount of this ticket is $500 or $700. I cannot claim in my tax return 1,000 as donation $1,000 because already I got back 700. So I can claim only $300. Also, there is amount of $200 that you can claim in the tax return for the donation, but it's not going to give you any impact on the tax return. The amount that you can claim will be up to $200 in order to have those impacts on your total amount that you are claiming. Okay, any question? Okay, the other one is the medical expenses. You can claim like the medical expense for yourself, for your spouse, and for the dependent child, which is under 18 years of age. These expenses can include like the dental care, can be the medical supplies, can be the private medical insurance that you are paying, including like the travel and the eye care that you have. You may even claim like there is expenses that you are you paid outside of Canada when you were for the vacation. You can claim even that one in your tax return, but you have to keep the receipt all the time. That one is important. So from your total medical expenses, the eligible amount that you can claim is 3% of your total income for the medical expenses. But it cannot go more than 3% of your total income, generally. And the last one is the childcare expenses. You can claim like the childcare cost paid to the day nursery, can be daycares, centers, can be the caregivers such as nannies, overnight boarding schools, the camps that provide like the lodging, the day camps, and the day sports schools. There is a question that you may ask me. How much childcare can you claim on the taxes? How much will be the amount? So for the week, for 1 week, for the child which is under 7 years old, so will be 200. For the child which is like up to 7 will be 125, and for the child with the disabilities can be around 275. Okay. Okay, any question? You don't have a question? Because, okay, for the tax return, I don't know, maybe you have only the T4 to claim on the tax return, but let's say you have one of those items that I mentioned, so you can add that one too. If you have any question, you can be more than welcome to send me emails and I can help you with that. So can I ask you a question now? Yes.
I think it's Alex speaking here. Great job. And if you can answer Donna's question about tax refund, so how can she get the biggest tax refund possible?
So the first, you have only, where is the question? So I can.
It's in the chat. She was like interested to see and learn about tax refund.
Okay, so she's the first, she's filing tax for the first time. When you are filing the tax for the first time, you have to know that you have to complete even the GST, HST application form that you have to send extra to the CRA in order to get those amount, the benefits, the credit amounts that you are getting from the CRA for the Ontario Trillium benefits and the others for GST, HST. So if you have only T4, you cannot do too much. But if you have like the business, or if you are working as, if you are self-employed, let's say, then you can add like expenses and in order to reduce those incomes. But you have to play a little bit with those expenses. You cannot claim more than the total income that you have for the business that you are doing. So depends on what the documents you have in your hands. This is the reason why I added all those, the checklists. Because if you have only one T4, with one T4, we cannot do something. But okay, even if you have one T4, you can claim those. If you are married, you can claim the childcare expenses. You have the child, the medical expenses. You have, if you have them, you can claim even like okay, the moving expenses, because this one okay can be a little bit rare, but depends. If you have like the income, okay, like the pension income from outside of Canada, you can claim that one too. So those expenses you can be easily claimed on the tax return. But again, depends on the documents that you have in total.
We have a few questions regarding
Yes.
medical in the chat. I think Monica has some questions about what is counted. Does dental?
Yes, this one is counted because the physiotherapy is one of the, is regarding the health. It's going to be just the massage. No, the massage is not claiming. But those is the one that you can, even your insurance, the private insurance is paying for that. If you have like the receipt, you can claim.
I think also in the question, there's someone that asked is
okay, for medical bills, will cosmetic procedures count? The cosmetic is for the beauty, cannot be for the health, according to the Canada. So you cannot claim the cosmetics for the medical bills.
I do have
for any optical too, yes. For the optical and the medical, the dental, yes, they are included. So let me check the chat if I left something. No.
Margleta, is
yes.
Massage through an RMT, a research massage therapist, is that not included?
The one for coming from the therapist, yes. Okay. But the massage that you are doing just to relax yourself, no.
Okay, I thought it won't be.
Just for pleasure. So
no,
cannot.
Maybe, I'm not sure because I've heard this before, but like, are prescription drugs considered part of like a returnable?
Yes, those, yes. You can add them even from the shoppers that you are getting, not the ones that you are getting by yourself, the ones that the doctor is giving to you. This one, yes, you can include it.
Alrighty. I think that's all the questions that we do have in our chat today. But once again, if there is other questions, please feel free to reach out to
Yes, you can send me like an email anytime, so I can advise you for that, no problem.
Awesome. Margareta, would you be able to send back the host to myself, please?
Yes, let me stop sharing first.
Okay, I'm just gonna admit all here. I thank you everyone who joined us. Sorry, let's wait for a few more seconds while they're connecting. Just give it like 2 more seconds. All right, well, thank you so much, Margareta, for
Thank you.
But once again, so for the people who just joined us, this session is recorded. So if there is something that you want to go back to the discussion, this will be posted soon. And also, if ever you do have questions, Margareta would be able to share the contacts later. And she'll be able to answer some of our questions. And hopefully, we get our taxes filed properly, and as much as possible, we get our refunds.
That will be good.
Yeah, I didn't know that, like for myself, I didn't know that it's RSP, not TFSA, that gives you credits.
Yet, no, that one tax-free saving account, okay, will help you for the tax, but it's not going, you cannot claim it for the tax return, just the RSP account.
Yeah, that's what I thought. I was like, let me just do TFSA and not RSP. But like after today, I'm like,
no, for the tax return, if you want to save some money, yeah, you have to check that one. You have to use the RSP account.
Awesome. And Margareta, I do believe that you do have a question for the team who are online today. And we just want people to answer through the chat. So Margareta will be asking a question and they will be, oh yeah, Margareta, would you be able to drop the email?
Yes, yeah, just I'm sending here right away.
Before we do our game giveaway?
Yes.
Really, let's just pin that. Okay, how do you pin? I don't know.
Okay, I have only one question that I mentioned it during my presentation. So I'm testing you now.
Oh, here we go. Just so you know, board members can't win anything, so
okay.
And all relax. Awesome. So
Okay.
the giveaway would be a JBL portable speaker. So please contact myself if you are the first person or if you're the one who won for this round, and I'll connect with you on how you'll be able to get your prize. Awesome.
Okay.
Etta, your question, please.
It's an easy question. What is the capital cost allowance? So what is the capital cost allowance? I have mentioned it. Okay, I'll give you like a small cue on the rental income and also for the residential.
Come on, let's see who paid attention or who has this knowledge before. Just please type your answer and we'll see.
So it's an easy question.
I think people are Googling it, right?
No answer?
We'll give it like a minute. And if no one answers, we'll probably go for another question after you provide us the answer.
Yes.
Yeah, and I just wanted to add, like for those who just joined, I would strongly recommend you to watch recording when you'll have a moment, because Margletta's presentation is very, very helpful and useful.
Okay, it seems like no one could get that answer. Margletta, would you be able to share that answer?
Yes. So like the capital cost allowance is the one that I mentioned in the rental income. So it's the amount of amortization expense that the government will allow a company to deduct from its income for the tax return. Just is the amortization expense that you are using for the. So the capital cost can be even for your vehicle expense that you have for the business income. So even for the rental income, for the furniture and property, like the computer, telephones, all those products that you can calculate the amortization.
Awesome. So the answer is amortization amount.
Yes.
Do you have another question for us?
Well, for the moment, no. So
Like,
no, I don't know.
let's do one more question for the giveaway. Let's do something easier.
So, okay, I'll give you another one. So what is the deadline for the RSP in order to contribute for the RSP for the 2022 tax return? I think Monica.
Monica, you're fast.
Yeah.
Margletta, would that be correct?
Yes, the March 1st is the last day that you can contribute for the RSP account for 2022 tax year.
Wonderful. Well, congratulations, Monica. I'll actually send you a direct message here on Zoom. And on that note, once again, thank you, Margletta. And then
Thank you.
Let me just admit Anita. And then we'll pass this on to Alex, who would be doing the second part of this short financial literacy program. And Alex, take it away. Oh, sorry, let me give you the host. And Alex, if you do see people on the waiting room, please feel free to admit them.
Okay, I think I am a host now. Good morning, and thanks, Margletta, once again. Let me share my screen. Can you see my screen okay? Justin?
Yes.
Perfect. Let's start.
You want to introduce yourself first, sir?
For sure. So I am, first of all, I am an alumni of Centennial College. I graduated sometime in 2015. I volunteer my time at our Alumni Association, and also I work at the company called IG Wealth Management. I have Ukrainian background, and also I like financial planning. And today I'll be introducing you to financial planning. So if you guys have any questions, feel free to jump in. 1 second, I need to do this. Yeah, so just to get you started, a few questions, yes or no, you can type it in the chat. And I think, Justin, you can answer the second one now. What's better, TFSA or RSP? And really, it depends on the situation, I would say. We'll talk more about it. And also, do you know if life insurance has anything to do with taxes? Like, a lot of people would think that not really, but there are some tax strategies that you can utilize with that. Also, should you be putting your assets in a joint name with kids, and should you do split income? That might be more challenging questions than other ones. But also, if you have a business or you look into how, oh, we have Anita who is joining us, I'll admit her. If you have a business, a corporation, should you be taking out money from your corporation first before RSP? Do you know how much taxes you'll be paying for 2022 or for your future years approximately? So, when we do financial planning, we focus on 6 main areas that you can see on your screen. I'll go through details of each one of them briefly. So usually you want to start with your cash flow. You want to analyze your income, look at your pay stubs, see what are the deductions that your employer makes, see if you can review your group benefits, group pensions, group retirement plans. Also, make sure that you have a budget and you review your expenses regularly. Like again, we usually recommend at least monthly, but it will put you in a habit of tracking your expenses and potentially cutting some of them as well. So again, residential lending, it's important item as well that you can utilize for your cash flow. For example, if you have different debts, different liabilities, you can take a look at them, see what kind of interest you're paying. For example, credit cards, you're paying 20% interest on that. You have some loans where you're paying 12%, 8%-ish. Car loans, line of credits, see if you can consolidate it and put it under the cheaper loan. So it will free up some cash flow for you so that you can use for something else like your savings or paying off some other loans as well. So preparing for unexpected, that's an important item as well for you to consider, because if you have a family, if you have dependents, they are relying on you. And you want to make sure that if something, God forbid, happens to you, you have protection in place. Either it's from your employer in the form of a group benefits, or it's individual plans as well that will cover you. And also look at wills and power of attorneys. We'll talk about it later, but these are important documents as well that you need to have. So when you're looking at planning major expenditures, like, for example, you're looking to buy property, buy a vehicle, travels, buy business, again, you have to do some planning as well around that. Figure out who would be the best lender to approach, in what form of lending you're looking to do that, and things like that. Maximizing your business success. So again, depends on where you at. You might consider different corporate structures. Prepare your business to sell, to pass it to next generation or to other beneficiaries. Do some estate planning as well, and also figure out if you need to do like move something that you own personally to corporation and vice versa. How do you take money out from your corporation? Is it in the form of dividends, salary, or you're just paying back the loans? And again, Marglada would be the best source of that information as well, because I know for sure they do a lot of corporate taxes. So optimizing your retirement as well. Again, what do you take out first? Like we leave, we accumulate funds, we save in those RSPs, TFSAs, corporate plans as well. When you are planning your retirement, think of what do you take out first? When do you retire? When do you start your old age security? When do you start your CPP? Because you can start at a different date and it will affect the amount of pension you'll be getting. Do you take money out first from your TFSA, RSP, or some non-registered accounts that you have? And then Marglada also talked about charitable givings. So do planning around that. A lot of times you would donate some funds in the form of a cash. You're not getting charitable tax receipts, and unfortunately you're losing some benefits from that because you don't claim those donations. Again, there are different ways to donate. You can set up a donor advised funds, like we can talk about that later. You can have your own charitable foundation potentially as well. You can donate through an annuity or life insurance as well. So again, do some planning around that so you can create a win-win situation for yourself from a tax perspective or for charitable organization. You can do an in-kind donation and get a charitable tax receipt for that. You can donate funds from RSP. Like these are just examples. I don't know why, but it's not moving. I need to click it here. Yeah, so before I move on, you guys have any questions? I think we have something in the charges. Oh, okay, so we're just thanking Margleta. Sources of your income, they matter. And here's a little bit of a difference between income and cash flow. It's not a formal verbiage, but basically think of it that income is more like what you put on your tax return, and cash flow is what you got in your pocket. So you can utilize some regular form of investment where you are accumulating funds in a non-registered account. That would be your checking account, saving account, cash investment account, or we call it non-registered as well. That's where, as Margleta mentioned, you have to file taxes every year for all interest income, dividend income, capital gains. And you will get those tax receipts that you have to attach to your tax return and pay taxes on that based on your threshold where you at. Then you can also utilize deferred vehicles, and Justin, that's your favorite RSP here. So when you contribute money to your RSP, you get tax deduction, so you can lower your taxes there. Also, when your funds are staying there, you don't have to pay any taxes. We call it tax deferral until you actually take money out. Exception is your home buyers plans that we had, and also learners plans. So you can take money out there tax-free for your education or for your home purchase, but you have an option to pay them back into that RSP within next 15 years. Otherwise, you will lose that contribution rule. So you can utilize a corporation as well and do tax planning around that as well. So corporations, they are usually taxed at the lower rates. Again, depends on how big is your corporation, but you can take advantage of that and accumulate assets under your corporation. You can also put, for example, permanent life insurance under your corporation. You can put like disability, critical illness insurances, your health, dental under corporation, and take advantage of that. Because if you have a corporation and then you have your protection plans personally, you basically have to pay yourself a salary or dividends, pay taxes on that, and then with after-tax dollars, you have to pay for those expenses that you have. So with corporation, you can take advantage of that. And then tax-free vehicles as well. Again, Justin, your TFSA, so you're accumulating funds tax-free there. As Margleta mentioned, you don't take advantage of tax deduction because you don't get it, but you're also not paying taxes when you take money out. So if you were to invest in TFSA in some stocks, for example, like $10,000, in few years, let's say it grew to $1 million, you can take it out, you don't pay any taxes of that. I'm just like exaggerating this example, but that's just for you to understand what's happening. And you don't lose a contribution room if you take money out, because January 1st next year, it resets. So you can take money out, put them back in next year, and you'll be fine. Again, life insurance example, that's where you can do some tax sheltering. Principal residence example that Margleta has, again, take advantage of that as well if you can. Now, Margleta kind of walked us through this, but it's more like a summary. So basically, you need to calculate your total income from different sources if you want to file your taxes, then utilize all the deductions that are possible for you. As Margareta mentioned, you don't have a lot of options if you're just an employee somewhere, you are not self-employed, you don't run the business, but you can still take advantage of your RSP contributions, interest on different business loans or investment loans that you have, and also advisory fees. Like, keep that in mind as well. When you have a non-registered account and you paying fees to a brokerage, for example, or asset management firm, you can deduct those advisory fees for tax purposes. And then after that, you apply tax credits, and that's where you basically figuring out your taxes payable, right? And that's to Donna's, I think it was Donna who was asking about tax refund. That's where you basically calculating if you'll be getting any tax refund or not. So yeah, deadlines, we talked about it. Filing tax, it's April 30 if you're employee, like employed individual. If you're self-employed, it's June 15th. But again, for self-employed, it's important to remember that if you owe money, you have to make a payment before April 30th for that. So a couple of things here. So we are in Canada in a progressive tax rates environment, meaning that you are not paying the same tax on every dollar that you make. Like, more money you make, more taxes you'll be paying. And also it's beneficial to utilize lower tax rates where possible. I want to show you a couple of sites that I really like, and it will illustrate you what I've just said. So here's the Ontario tax brackets, and it will show you that, for example, like first 49,000, you will be taxed at 20% rate. If you make from 49 to 53, all this income will be taxed at 24, and then it grows. So there is something that is called like a marginal tax rate, and that's what it is. And then you can figure out the average one. So in Ontario, it's the province with one of the highest marginal tax bracket. If you're making over 235, you'll be paying 53.53. So it's like more than half you will be paying in taxes at that point. So you have to do a lot of tax planning there to figure out how to bring it down. And also, I really like this this Wealth Simple tax calculator. So Wealth Simple is one of our well, we have a strategic investment in it, but it's more like our sister company as well. We are under the same umbrella, but basically you can look at different provinces. And if, for example, it's Ontario, so for example, $100,000 of income, it will give you right away the number of federal tax and provincial tax. You'll see also how much of a CPP and EI you'll have to pay as well. And that's what I was referring to, marginal tax rate and average tax rate. So for example, marginal tax rate is 37 here. So if you can look at here, you'll see like that's where you are. That's the marginal tax bracket that you have. But the average will be lower because it's a combination of these ones, right? So let's go back.
Alex,
yeah.
So is that, for example, the moment you hit, can you go back to the chart, please?
The chart, sure.
Yeah, so for example, the moment you hit 49, let's say 232, so that $1 difference will be 24.15 in tax.
Correct. So starting with like 49,232 up until 53,359, each and every dollar will be taxed at 24% tax rate. Same here, like each and every dollar will. So here, like every dollar you make 53 cents, you'll be sending to CRA. Basically.
Thank you.
Yeah, no problem. So let's move on. Yeah, if you have any questions, feel free to jump in. Here, so some considerations that you might have. Splitting your income where possible. Again, Margleta can help you with that if needed, but you can split your like RIF accounts. So RIF, Justin, especially for you. So at some point, RSP will have to be converted to RIF, and it's age 71. So basically, at that point, government says that you've been great in saving funds. Now you have to take it out. You cannot save there indefinitely. So you will have some minimum amount per year that you have to take out from there, and you can technically split it as well. And you can also split the CPP as well. And that's where we can chat a little bit more about difference between RSPs and TFSAs and non-registered and what's better. But TFSA contribution limits, they usually provided by the government every year. For this year in 2023, you can put additionally 6,500 to your TFSA. For RSP, it is individual. It's based on your last year's income, and it will be 18% of your income that will be added to your RSP contribution that you can take advantage of. So an annuity, it's a great vehicle that you can utilize. Not a lot of people take advantage of it. Usually it's applicable when you transfer pension from your employer or you're looking to retire. So if you've been accumulating some funds with your employer through group retirement pension plans, if you leave in that, they'll give you some option. You can leave it there, you can transfer it over to your own possession, or you can convert it to an annuity. What is an annuity? Annuity, think of it as like potential pension income that you can get. Technically, it's a contract between you and insurance company, and you can have, for example, like you've accumulated $500,000. You don't want to be exposed to market volatility. Like you don't want to see your investments going up and down, etc. You can purchase an annuity with this $500,000, and it will pay you monthly until the rest of your life, or for some period of time, indexed to inflation, without any questions asked. So you don't care what's going on at the market. You just get your paycheck and you live off it. So you basically buying a pension income for yourself. And also, again, it's without going into details. Life insurance vehicle. So that's where you can shelter your assets from taxes, and you can take advantage of it while you're alive. And you can also help your estate as well. Estate, it's where like you planning how to transfer wealth, your assets to next generation, for example. There are different ways to do that. Usually it's with permanent life insurance. We call them whole life or universal life. And basically think of it as almost like you have a tax-free savings account inside this policy. The assets that are growing there, they are invested by insurance company. You get dividends on top of that, and it's vested. So that's the beauty of it, that vesting means that once it's there, it will never go down. So it is protected value that you get. And basically, if you want to take advantage of this account while you're alive, there are 3 ways to do that. You can go to insurance company and tell them that I'd like to get a loan and use this cash value as a collateral. You can go to the bank and do that. And banks, they love these products because they know it's very, very safe. Like it's not volatile. If you'll go to the bank and be like, I have a property, I want to take a loan against it, like home equity line of credit or so, they would usually look at 80% of the value because they know that the markets can go up and down for real estate. Here they can finance it up to 100%. So they know it's very secure assets that they can use. Or you can just take it out. We usually don't recommend taking it out because it cancels the plan entirely. So you have, like when you do financial plan, you have to figure out where you're at. Like you are in accumulation phase or you are in distribution phase, and planning will be different based on that. So this one is an important item to keep in mind. So inflation, like last year, inflation was very high. And if you'll add taxes on top of that, you'll realize that you need to save more just to be able to accumulate enough funds for future. So this is the example that shows a different inflation rate. So if you, for example, have $1 million now, in 25 years with 2% inflation, it will be worth 615,000. Just 2%. If you look at 4%, it will be worth 375. So if you think of it like you're looking to retire, for example, in 30 years, and you think, well, like $5,000 per month at retirement might be sufficient for me. If you'll take into an account taxes, inflation, you should be having like $15,000 at that time per month, just because of that inflation. So withdrawal rates as well, that's an important item to keep in mind when you start taking money out. Again, we usually recommend 4 to 6% of your assets to take out annually. So for example, if you have saved $1 million at retirement, just an example, so $40,000 to $60,000 that you can pull would be okay. Otherwise, if you do more, sooner or later you'll run out of money. And also consider taxation again, because if you're taking money from your RSPs, if you're taking money from your pensions that you've accumulated with employers, so you will be paying taxes on top of that. So this one, staying healthy, it's not pertains directly to tax planning, but again, it also kind of related to a tax system, because we paying taxes to basically get something back from government, including our provincial health plans. And we are advocating healthy lifestyle and etc. But I just want to give you an example that sometimes even if you are healthy, there are some things that happen that are unexpected. And I really like this this risk calculator. So here you can also project the risk for yourself or for your partner if you'd like to. So just as an example, if we'll do both male, 30 years old, non-smoker, female, 20 years old, non-smoker, we want to see the results for their health and probability of some events happening to them. So they're young, relatively, they're healthy. Still, there is 33% of a chance that one of them will become disabled before age 65. Critically ill, like heart attack, stroke, cancer, things like that, 23% of a chance. Somebody will die before age 65, 12%. And that's statistics in Canada. It's not like, again, really depends on the situation and stuff and genetics and etc. But there is 51% of a chance that one of this one will happen to both of them. So why is it important from financial planning perspective? God forbid something happens like this to them, they'll have to use their savings to cover those expenses. They will not be able to work potentially. They'll still be having some expenses to cover. They might have some kids that have to be taken care of. Like, we don't want to be dependent and run out of savings. That's basically the idea of transferring the risk to insurance companies. Again, like you need to review your group benefits with your employer, but also we usually suggest that you have your own personal, like individual plans. And the reason is that your group benefits, they're highly dependent on your employer. Like, your employer can cancel them. They can transfer you to like a contract position. You might lose those benefits. You might leave that employer. You will lose those group benefits. If you want to start your own business, again, you have to get something on your own. And that's the idea behind it, that hopefully by that time, when it happens, you're still healthy and you didn't develop any health conditions. But if you did, insurance company might say that, sorry, we cannot insure you, or the prices that they'll offer, they'll be, we call it rated. They'll increase Sorry, I think we have somebody waiting in the room. Fritzi Katara. So I've just admitted the person. So let's go back. Sorry, any questions on this one? No, it's all good. Sounds like I'm doing a great job. No questions. So a little bit more about estate planning, and then we'll jump to an actual financial review. Just very briefly, more than 50% of Canadians do not have signed wills, and they think that the government will take care of them and their family. Unfortunately, it's not like that. We have to pay taxes while we're alive, but also CRA comes after your assets when you're no longer around. And they basically, there is a procedure. You have to have an executor, ideally somebody who you can trust, who can settle your estate and distribute your assets to your kids, to your spouse and family members. But also they have to pay probate. Probate is like extra fees that you pay into CRA, basically to confirm that you are who you are and the assets that you own there, they were in really like in your possession. But also you will have, or executor will have to pay taxes that will be triggered at that point. And again, it comes down to your rental properties, your non-registered accounts, your RSP. If you don't have a spouse, to transfer it as a spousal rollover, they want to tax it as like taxable income. And that's a big challenge now for people who are seniors who are doing estate planning, because they've been great in saving money in those RSP. Justin, again, for you, just a high-level planning. So keep in mind that if you are saving your RSP, you, again, most likely you want to use it before you pass away. The reason is that if you don't have a spouse to transfer it to, in this case, it will be like a tax-free spousal rollover. Then, for example, you save there $500,000 and the person dies at that time, for example. $500,000 will be treated as taxable income. Do you remember in Ontario, what would be the tax rate if it's more than 235?
53 something.
That's right. So 53% of that RSP will go towards taxes. So do some planning around that. And also, basically after that, executor will have to pay off loans that the person had, and then only after that, with whatever is left, will be distributed to beneficiaries according to the will. If there is no will, there is a special formula that government uses to distribute wealth, and it might not be the way that, let's say, you want it. So that's why we're asking people to take advantage of that. And also one thing is power of attorneys. So power of attorneys, does anybody know what is the difference between power of attorneys and wills? Okay, let's how about that? Like, we'll keep it as a gift question. you can research it for now, and I'll answer it later. So again, your sources of your income, they might be different. You are looking at income from your employment, income from your business, investment income, RSPs, briefs, all age securities, CPPs, and annuities. So that's how you form your paycheck. So financial planning path is very simple. You started with reviewing your current situation, where you're at, what are your goals, what are your concerns. You analyzing it, you're trying to understand where you're going with all of that, and then you build strategies accordingly. Then you start basically reviewing it if things are changing. So I'm going to jump to a financial review document. Sorry, any questions? We good? That's pretty good. I love when people don't have questions. Just kidding. So goals and concerns. So that's where, like, I'll go through first step of financial planning with you. It's data gathering, and it will be just an overview of that. I think Justin is trying to see it better. Let me zoom in.
Sorry, I have glasses, but I'm still blind.
Yeah, is it better now? Yeah, So start with this one. Just start prioritizing different areas of your life. Whether you want to pay off the debts quicker, you want to stay ahead of cost of living, just rate it from 1 to 3. Again, family protection is important for you. Reduce your income taxes, owning your business, and things like that. So just define 2 to 3 items that are very important for you so you can focus on them. And that will help you to work on your financial plan and do things accordingly. So then start with basically putting together an information of what you have currently. Like you'll look at your tax returns, your notices of assessment, review your employment booklets, plans, mortgage statements, loan statements, pension statements, things like that, wills and power of attorneys as well. So I'll skip this one. We just ask clients to provide general information, but here's the cash flow information that you need to basically analyze. You can utilize some Excel spreadsheets. There are some different templates that you can take advantage of. But again, put down your income, like you, your partner, what are you making gross? What is your net per month? And then go over each and every category and put them together. So you'll figure out what would be your surplus or deficit, and that's where you can start working on that. If it's a deficit, look for ways to cut expenses to make more money. If it's a surplus, now you can figure out how much you'd like to commit to your goals that you've basically defined in the previous step. Also put together some information about your employment. It's important also, like we see cases that people would move from one employer to another employer. They would leave those group pension plans with former employers instead of transferring them. And they sometimes forget about them. They will not take advantage of a conversion opportunity that their group benefits are offering to them when they transfer or they leave employer. Also put together who are your dependents. Is it your children or parents, or you have somebody who you really take care of who has some health problems? And I'll explain you why it's important, because, well, it affects your cash flow, but also there is some additional planning that you can do around that. Put together what are your assets currently. Like deposit accounts are usually your bank accounts, like check-in, savings, and etc. Life insurance, cash surrender value, that's what I was talking about before. Pensions, your non-registered investments, your registered investments like RSPs, TFSAs, etc. Your real estate, your other assets, and that's where you put your total amount of assets. Then you put information about your liabilities, and you want to analyze them as well. Like you have a mortgage, you have line of credits, you have loans at different rates. Look at them and see where you can consolidate them. And also, remember, take advantage of it from a tax perspective. If you have some investment loans, business loan, or rental properties where you have some mortgages on that as well. And that's where you're basically figuring out your net worth, like assets minus liabilities. That's where you see your net worth. And you want to constantly put the pressure on increasing your net worth through different strategies. So then you review your family protection plans, again, group and individually owned in details. You want to see exactly what is the disability insurance that you have from work. Like people would know how much they get for their massage, chiropractic, dental, drugs. But if you ask them, do you have a short-term, long-term disability coverage at work? If you do, how much are you covered for? How much is going to pay you? What's the definition of the disability? For how long it's going to pay you? For like, usually people don't look at those details. Critical illness it's even, again, it's like more optional. Employers can have it and provide it to you, or they might just, again, not have it because they want to cut the cost for them to provide it to you. Healthcare coverage, again, if you're self-employed, chances are you have to buy some individual plans. If you're business owner, you can put it under corporation, as mentioned before. Property insurance, tenant insurance, landlord insurance. Again, look at those details as well. There were some cases where, again, like some unexpected events are happening and people have to pay from their own pocket, and it really affects their situation and retirement planning, etc. So that's an important item as well to keep in mind. RDSP, Registered Disability Savings Plan. So it's very similar to our ESP, Registered Education Savings Plan, where like usually Canadians are more familiar with. In our ESP, you as a parent, for example, or family member, you can save money in our ESP and government will do matching up to 20%. So $100 in, you get extra $20 from government. There are some limits. It's like $7,200 for the children, for one child, sorry, per their like lifetime. But also with RDSP, matching increases from 20% to 300%. So if you have somebody like family member who has a disability, unfortunately, government supports those people. And if you were to save $100 in RDSP, government can match it with additional $300. So that one is, there is a criteria that you have to meet from a family household income in order to define the matching percentage, but it's a very good strategy. And you won't believe, like a lot of people, they're not taking advantage of that because nobody explained it to them. Now, estate planning. So wills and power of attorneys, importance of, like, remember that's a gift question if you want to have a GBL speaker. But basically, in a summary, will help you to define who is your executor, who is your guardian, who will take care of your kids if you're no longer around, and things like that. So that's an important item to have. For power of attorneys, I'm leaving it for later. Who are your beneficiaries? Like you have RSPs, you have TFSAs, who would be the beneficiaries of those? If you have multiple beneficiaries, did you consider all of them? If you have like a blended family, if you have previous marriages, again, consider that as well. That those funds will also might be affected in terms of how much exactly beneficiaries will get and what percentage of taxes you'll have to pay, because different assets, they are taxed differently. Like for example, TFSA doesn't have any taxes now or later when person is no longer around. Where RSP, as I mentioned to Justin earlier, there might be some taxes that you have to pay. So if you have 200,000 in RSP and you have 200,000 in TFSA, and you have one child who's a beneficiary on RSP, another one on TFSA, chances are that the one who's getting the RSP assets will get less than 200,000. So keep that in mind. We call it estate equalization. Like, is it equal? And it's just like a very simple example of that. Our ESPs, so important item as well. Are you taking advantage in maximizing government grants? Like from the year when children were, let's use one of them. From the year when the kid is born, you can take advantage of RESP and contribute basically $210 per month to maximize the government grant. A lot of parents, they would miss on that, and you can take advantage of that and you can catch up 1 year at a time. So again, think of that as well. Retirement planning, it's a little bit more complex. So like I'll skip it, but there are considerations as well, like how much money you're looking to spend. Are you planning to spend? Will you be working at retirement part-time or so? When do you start your CPP? When do you start your old age securities? What are your applicable tax credits and things like that? If you have a business, again, what's your corporate structure? Like, do you have a holding company, or is it just like operating company, family trust and things like that? Keep in mind that you can have pension plans from your employer, defined contribution, defined benefits. Again, they are different. There are different versions of them that you can also review and take advantage of, but there is planning that needs to be done around that as well. And also like your carry forward rooms, your contribution rooms for your TFSAs, for your RSPs, you might have some pension adjustments as well and things like that. And also remember, if you're subject to tax in the US, and I'm pretty sure Margleta can attest to that, you might have some extra complications with your tax filing. So yeah, I'm done here. Thank you very much. Do you guys have any questions? Oh, you can't even see me now.
I'm sure there will be more questions when, you know, people start thinking more of their finance planning.
Oh,
Would you also mind dropping your email address for people if they would like to reach out to you?
I can definitely do that. Do we still have people here?
Yeah, we do.
Sorry,
So
I think you need to make your host now, right?
Alex, can you repeat the question that you were asking during your thing, what the difference was between, so that people, I was gonna write it down, but I missed the question. I wasn't sure there was difference. This is
Yeah,
a
difference.
big all in all to me, so.
No worries. Just 1 second. I'm bad with multitasking. I need to make.
I can type it out.
No. Like I just want to make your host first. Oh, here. So, Frances, the question was, what's the difference between will and power of attorneys? When do you need them? Special power of attorney, okay, versus will, yeah. Ernesto.
Ernesto, answer that question, and that speaker is yours.
No, hold on. It
Oh,
wasn't
hold on.
answer. It's not that quick. So like, I'm not really sure what he means by special power of attorney versus will. So I'll give you a hint here. So we have two power of attorneys, one for health, one for property. I just want to, like, general idea, what's the difference of power of attorney and will? When do we need will? When do we need power of attorneys? That is the question. That's right. Well, at least you paid attention to a question, you know, maybe we should consider giving you a speaker there. Okay, I'll think I'll answer that for now, and I'll have another question. Justin, are you okay with that?
It's up to
Yeah.
you, sir.
So wills we need when person is no longer around to help to settle that estate, pay probate, pay taxes, pay off the loans, pay to the beneficiaries. Wills we need when person is still alive, but he or she is incapable of making
Sorry,
his or
Alex,
her
I think you said will is when it's alive.
No, will when
It's
person
when-
is no longer around. Yeah, so that's when we need that. For power of attorneys, we need them when person is still alive, but they cannot make their own decisions. Like they are incapable, whether they are in coma or they are disabled or they have mental issues, and then things like that. So there should be someone who will jump in, who is trusted person, who will have a chance, like for medical power of attorney, to decide how to treat that person, where to treat that person, and things like that. For property, that's an important item as well. Like you don't feel it until you actually need it, but you have to cover expenses for that person who's incapable of making those decisions. And again, different decisions needs to be made. Like you have to transfer money from their investments, you have to rebalance them, you have to again use their bank accounts to cover some expenses and things like that. So without that power of attorney, financial institutions will not be able to help you. Like you will have to go through court to obtain that permission to act on behalf of that person, and it will take time, it will add additional cost to that, right? So that would be the main difference. Now I'll go with easier question. Justin, go ahead.
Sorry, just like probably further clarification on the power of attorney.
Yeah.
So who can be the person who will be given the power of attorney, and who will be the executor of will? Probably just give that clarification for everyone.
Good questions. So usually we recommend a person who is your trusted contact, who is in the same province where you are. And if there is like a lot of immigrants that we have in Canada, if there are no person who you can trust here, you can consider someone from other country potentially. There are complications with that because that if it's like executor, they'll have to post a bond. Bond, it's like an additional insurance that they'll have to get. There will be an additional cost to that. But basically through this insurance, you guarantee like that executor basically guaranteeing that he or she is not taking money and running away from the country, right? But that's the basic idea. But also you can appoint a corporate executor and corporate power of attorney. So there are some companies, in our company, we use Concentra Trust. They're pretty reputable and have a lot of experience with that. But it's an organization, like institution, who you can appoint to act as a power of attorney or act as an executor. You don't pay until they have to act, but if it happens, you are protected, and they will act in the best, like in the best interest of that person who passed away or who is incapable. But good questions, Justin. Thank you.
Just to appoint your spouse or your child or very close family relative as one or the other?
You can have different ones. You can have a primary person, you can have a secondary person, and just to make sure that there is someone in case if something happens. And again, it also comes down to planning. Like if you're looking to appoint your parents as an executor or power of attorneys, like consider how old are they, how well they again take care of the money and stuff like that. Will they be able to help you? So the easier question is, what's the TFSA contribution room for 2023? Margleta, I know you know, but okay, Justin cannot answer that. Monica, you've been pretty active. You want another speaker? Ernesto? Donna is working, but you were able to type messages.
Yeah, I can't answer that. I just looked at mine too. Well, as you're speaking.
Oh, wow. How many more questions I should be asking?
Just consider this, okay? For me, it's like I maybe heard this the second time with Alex, so I'm still new to it. Like it's such a new language for me. Finance is literally, I don't have that literacy. I just don't. And so it doesn't come as naturally to me. So you're not alone. If this is your first time hearing it, it's okay. This is why we have Alex, why we have Margleta, because they're here to help us. They're experts, and I know we have a lot of questions. So if I don't know, Justin, if you think maybe if people can't answer questions, maybe we could either do a raffle or like a draw, or someone asks some questions.
I can do another one, and thank you, Francis. I totally get it.
We should answer that question first, the one that you just asked.
Sure. So it's 6,500 this year, and just to summarize it, basically for TFSA specifically, every year government gives us additional contribution room, and everyone gets the same. So again, if you maximize it already since I think 2012 when they've created it, 2009, every year there was a different contribution room. So it accumulates if you're eligible for that. So if you maximize it already, now you're looking to contribute more this year, it's 6,500. You can look it up at your specific contribution room online, my account CRA, and you'll get the answer there. And the same with RSP.
And RSP and TFSA both have different, and TFSA is a specific value and RSP is percentage?
Yes. Well, yes. So TFSA is the same for everyone. RSP is individual, and it's a percentage of your last year's income. So it's 18% up to a certain limit. right? But good question. So again, another question, Princess, maybe tell me if I should be given another one, but what is the deadline to file your taxes in 2023 if you are an employee? Here you go. Another speaker to Monica.
242. Awesome. Congratulations again, Monica.
I think you can sync them, right? The GBL speakers. So now she can have like a home system.
Both of them. Not sure. But yeah, I think for the giveaways, that's what we have for today. And in behalf of the Alumni Association, I would like to thank Margletta and Alex for giving us insight on financial planning. I know this is not the last one that we're gonna have it. We're gonna have more throughout the year. So keep in touch, follow us on social media and Instagram, on our website. And I just want to plug in here as well that on February the 3rd, we do have our um, Black History Month kickoff. So we do have a show performance by talented African Americans in the Meridian Hall. Please feel free to check our website for it. And if you do have any questions for today's sessions, Margleta and Alex we'll be more than happy to answer your questions. The email is on our chat. And for the recording, once we do have this completed, we'll upload it or send it to the people who signed up for today's event. And other than that, is there any other question not related to finance or any related to our session today?
I just wanted to add something. Thank you and our team for hosting us here. And Margleta, thank you very much for joining us on Saturday morning.
Thank you. Thank you for the invitation.
Here, let's post Margleta's email again here.
Yes.
She sent her email here already.
Here.
Can use Margleta's.
Yeah. That is correct.
You can feel free to send me an emails anytime so I can reply to them.
Awesome.
Sounds
Thank
good.
you so much, everyone, and enjoy the rest of your Saturday. Stay warm, and I hope it doesn't snow anymore, but where can you get access to recordings? So we'll see what would be like the best fit. It's either we upload it on our website or we send it directly to the participants that join us today. You're welcome. Any last words, Princess?
Pardon me?
Any last words?
No, thank you all for coming. Thank you, Alex and Margleta, everybody that stayed.
Thank you.
Let's do this again. I think this is really helpful.
Awesome. Thank you, Francis.
Wonderful. Well, I do hope once again everyone has a wonderful day and see you in our next session.
Thank you. Bye.